Hello and welcome back to the continuation of session 1. So in this session, I want to go over the financial model, the pro forma, and based on what we just talked about, I want to show you where all this data and these assumptions are put in. So first we're going to start. This is a financial model that is basically built out with all the tabs needed to analyze the deal and enter the data. But the first step we're going to start is really the assumptions tab. Just to give you a basic overview, throughout the document, anything that is highlighted in yellow is really an input cell. This financial model is meant to be a plug-and-play type of Excel sheet where you're entering the data that you've gathered or the assumptions that you've made into the yellow cells, and then the cells that are not highlighted are either formulas or reference other cells and give you the output you're looking, that you can then go to an investment committee to pitch your project and put it together in your own slide deck on when you want to get approval for a project. So with that said, we're going to look originally at our site information. Really, this is what you can build on the site. So as I mentioned earlier, you can go to websites such as Zola or city websites, or maybe even get this information from a broker's offering memo that'll explain what is buildable on a site or what the property actually is already built or what its potential can be built. So you have your lot square footage, which is the size of your lot. You have your FAR. The FAR is your floor area ratio, or what multiple you're allowed to build on your lot for the square footage of the property. And then that calculation equals your zoning square footage. Then you determine how you want that property divided. As I said, we're going to focus mostly on multifamily in this course, so residential is going to play the majority of this property, whereas commercial is typically your retail first floor commercial area. In many instances, New York City will require a community facility to be part of your building, but in exchange for that portion of your square footage to be a community center, they're actually allowing you a higher FAR. So if you were to get a lower FAR, say at just 3, you see how it drastically reduces the size of the property, plus the residential square footage. Obviously, you won't need the community center, so this can get bumped up, but you are still below what you would if you had a 5 times FAR and were at 71% residential. So all factors to consider. You may or may not want to build that community center, but you should weigh it in. So you come up with your total zoning square footage, your community center, and any retail or commercial space that you may have. Then you want to enter your gross up factor. So this is basically your loss due to common corridors, whatever you may have as space, elevator space, shaft space, space in that square footage of a building that may not necessarily count towards the rentable square footage. Mostly affecting residential just because the various units on the floor compared to a community facility where it's just going to be one centrally located space. Your parking mechanical is then determined, your residential, your community facility, all your gross square footage, which will then be used to determine your actual cost and your income. So then you have your total buildable square footage. Again, your loss factor, your residential net square footage, your average, determine how many units you're looking to build, and then your average square footage for each unit, plus your total parking amount. So once you have most of that information inputted, you get a good idea of the square footage of the building that you can build on this piece of land that you have. Next is you start to populate your costs. your acquisition cost, your construction cost, your soft cost, your hard cost. So your acquisition cost is going to be your price per buildable square foot. You might also have just this is a calculation. You may want to modify some of these cells. If you know that you're purchasing the land for $5 million, you might just enter a $5 million in here instead and eliminate the need for the calculation in that cell. But for now, we're assuming that you're factoring it based on price per buildable square foot. Then you get into your building costs. These are usually estimates that you're putting together on each of the spaces. Residential with the most amount of finishes would be the highest. Your parking the lowest with not any finishes in place besides the structure itself. And then the various costs for each. And your contingency for, again, the unknowns, and it's providing a buffer. Your professional fees, also known as your soft costs, are really your A&E, your architect, your engineers. So these are based on a price per square foot of what you're building. So these are usually you can find these through comparables. If you've done multiple projects, you'll start to understand what are you spending on each project, price per square foot to design something, or you're going to go and ask your design team what they would charge. And at this early stage, they are usually going to give you just a price per square foot estimate without digging into the actual design yet. Your developer fee is the fee that the sponsor is going to take for building this project, which is usually anywhere 4 to 5%. And then in this case, we have a deferred developer's fee when the project is complete, which some investors like to see. Before we go into the financing costs, let's take a look at now the income when the asset is fully operational. So you're basically now determining your price per square foot per year for your rental income, your community center, your commercial. Typically, office commercial space is a triple net lease, which means that the tenant itself pays for taxes, insurance, and operating expenses, and that just gets passed on from the property owner to the tenant in their lease, which is beneficial for the owner because it's all in to the leasing income, and the owner is getting reimbursed for those costs. In this case, the parking is being rented out per month, so there's an income for that, and the amenity space. And then you see that we've actually factored in certain vacancy rates for each of the spaces, just to provide a realistic assumption that we're not going to be 100% leased out 100% of the time. So once you have that data inputted, you then come down to your expenses. In this case, we've actually created a separate M&O expense per unit. We'll look at that in a moment, but you have your property taxes and your reserves per unit. In addition to having, let's take a look real quick, just at this tab. Just jumping around a little bit, but I want to explain exactly what your maintenance and operating expenses are, your M&O. They're your utilities to run the project, supplies needed for the maintenance team on site, legal and accounting, repairs throughout the building, property maintenance, cleaning, pest control, equipment, service contracts, which is below, your staff on the building, whether you have security, you have porters, you have a building super, management fee, property management to oversee the building, and then insurance. So you have a total M&O expense that has been calculated based on the price per square foot of each of these, or a percentage of, say, the property management fee. And then in addition, you have a reserve the 250 in the last tab, and the assumptions tab is really calculating your CapEx reserve. CapEx, whatever is required, hold for future improvements and major repairs of a building. Let's go back to our development assumptions tab. And then the next part we want to do is actually project what our growth is. We're not only going to have growth in income, where our rents are projected to grow, but we also project growth in our expenses. As we all know, things get expensive every day, so we want to make sure we're realistic that in future years, we're not paying the same amount for cleaning that we might 5 years from now. So we're also figuring in a growth rate for our expenses. As we finish up the assumptions page, we want to look at our financing costs. 9 times out of 10, your project is going to be secured with some type of financing. So you're going to take a industry standard at the time that you're looking at this job and plug in your financing cost. That's not only, in this case, your construction loan that you would get when you're ready to build the building, but also in the future when you want to refinance and get a permanent loan. So you see that most of these numbers, most of these loan costs are coming from talking with your lenders, your mortgage providers, and seeing what they are charging at that time. Also, your construction term loan depends on the schedule of your construction, your lease-up period, how fast you think your rental building is going to lease and be fully stabilized. And then the interest rates on each of those loans, your construction loan and your permanent loan. These assumptions usually from project to project may remain the same, which is why you have them on this initial tab, really to start up. If you're out there analyzing 5 to 10 to 15 deals a week and really active in the market, you're not going to go back into this assumption page and change every single assumption. Your financing costs might remain the same for, say, the next few months or foreseeable future. If rates have stayed stagnant that whole time, if you plan to use the same lender that you used before and you know these costs, you're usually not going in to make all these adjustments. So I know it does seem like a lot of information to input at the start, but not all those will change each time. Similar to your professional costs, your building costs, if you're looking at a multifamily project, mid-range 20 to 50 units, and you've received, say, an estimate for construction costs from a contractor, and they've given you the $275 a square foot price. No matter if you're in that range and you're looking at a similar property, you're going to keep that pretty consistent. Now, if you're looking at a completely different property, say an office, that's where the numbers may change. You may be looking at something else, but then that becomes a completely different model than what we have here. And then lastly on this, we would look at the debt sizing. So along with your financing cost, you want to enter in what are the typical parameters that a lender's looking for when they're giving debt at this time when you're reviewing your property. What's the loan cost ratio that they demand? What's your debt service coverage ratio? What's the loan to value that you are getting from term sheets from your lenders? You may ask a lender to provide a term sheet, and that will be outlined in there. And then lastly in this assumptions page is really your equity portion. So you have your debt portion, and then you have your equity portion. Those are the sources of your total project that would go into investing into this property. So your equity would either be you, the developer, as the sponsor, or if you had an investor group coming in, you would enter what your split is between those two parties. You may have multiple investors, and you could split that out later, But for now, we're just trying to keep it simple as really the developer and any outside investors. So that forms the basis of your development assumptions and really the basis of what's to come with your cash flow and then your analysis of what the returns and what the property value would be. But I want to end here on this development tab and take a look at some examples of where you might get these numbers from.